All right, guys, welcome to the video. This is Prop Firm Challenge passing full course, as you can see in the thumbnail. My goal for this free and comprehensive video is to get you to go from losing your account challenges to not only passing your phase one and phase two, to get funded and stay funded. Why making such a bold claim? It's just because that over the years, I've seen a lot of so-called gurus coming in this industry saying that they have the magic formula to get you to pass your prop firm challenges. But the stats remain the same. Over 90% of traders who get into the prop firm space never make it to the funded status. By the end of the video, you will have everything that you need to go out and buy any prop firm of any size from any company that you like. You will be able to not only pass phase one, phase two, you will get funded. Now, that's if you decide to take two-phase challenge. You can even go out and buy one-phase challenge. In every section of the video, I will help you to identify where you are currently in your trading journey, how to have the right expectation when it comes to trading challenges, how to have the right mindset when it comes to trading psychology, and this will give you a massive edge over the 90% of traders who never make it past phase one. Teach you the right approach to do your market analysis. That means when you look in the market for trading opportunities, you will not be forcing the market to give you what you want, but you will be reactive to what the market is telling you. And on top of that, I will teach you a profitable strategy that I'm currently trading in my personal account. Before we get deeper into the program, what I will request from you is the next 45 to 1 hour of completely undistracted and laser focused time. This is the video that you've always hoped to have. And get in the habit of taking notes. Download the workbook. You can find the link in the description below. Bookmark the video, save it in your watch list for later because you're going to need to come back to the video to watch it over and over for it to make sense. Because after watching this video, you will be set. You will be ready to go and tackle any challenge of any size because you will not need another video to get you more confused about what you needed and what you have or what you don't have. Now, I would like to learn a little bit about yourself. Down in the description below, tell me where you are watching this video from, where you are currently in your trading journey, if you have purchased any account challenges from any prop firms out there, how has that experience been? And if you did not pass any of the challenges, how many of these prop firm challenges have you blown? And most importantly, what was the missing puzzle that prevented you from getting funded? With that in mind, let's get stuck in. A trader has to go through a series of phases in his or her trading endeavor or trading journey. The first one being the unconscious incompetence phase. This is where the trader is completely unaware of how much he or she doesn't know about trading. And the challenge that this trader faces is failing to recognize that the complexity of trading and risking too much capital without proper education. And that's when that trader will think he or she can earn a great amount of money in such a short period of time without the proper gear. The second phase is the conscious incompetence. This is when you start to realize how much you don't know about trading and how difficult it actually is. And the third is the conscious competence phase. That's when growth started to happen. That's when you start to develop and follow a trading plan and a strategy. You start to become more systematic and disciplined in your trading, and you actively work on managing risk, controlling emotion, and improving consistency. And consistency, that's when you start to be consistent in your approach when you do your pre-market analysis, when you're being consistent in the type of setups that you look for, being consistent in the type of entries that your trading plan tell you to enter when you have an opportunity that arises, and then being consistent in managing that trade after you've taken that trade. And after that, you're being consistent in how you journal your trade and how you do your post-market analysis. This is the growth period. And the last phase is the mastery. That's where you're being on autopilot, you are consistent in your analysis, you're consistent in how you do your post-market analysis, and you're consistent on how you take your trade, how you place stops and targets, how you manage the trade, how you use the risk and money management in every trade. You know when you're likely headed into a drawdown period because you've already had the data to back that up from your back testing. So by now, I hope you can identify clearly in which phase you are in your trading endeavor. That means if you're in a phase one, that means you don't know much about trading and you think it's super easy. That's probably why you go on confidently buy a trading challenge and then blow it in the first try. Making money in trading is simply a side effect of you as a trader following your trading plan consistently. And the type of traders who are consistently making money are the ones who trade it like a business. Just like any other businesses out there, trading is no different. And in fact, trading is more predictable when it comes to making money as a business because way before you can even place a trade, you can have the data that tells you if you're likely going to be successful with your strategies. What you can do, you can remove those strategies that are not proven to be profitable and only keep the ones that are profitable. The traders that are consistently profitable, they're process driven, not outcome driven. They treat trading like a business. They have a solid trading plan, just like any other successful business have a solid business plan. They only follow their own trading plan. They have a profitable system or systems that they trade. They journal their trades all the time. They have a routine in how they go about their trading. Let's say if they trade the London Open, they will be at their desk at a certain time before the London Open. Now, let's say for an example, if that trader trades the New York session, they will be at their desk getting their pre-market analysis going way before the 8 a.m. Eastern time. They have the right expectation. They know they're not going to be making a gazillion amount of return based on a 10 grand account. And they understand that even though that they might have a very profitable technical edge, but they also have a very good understanding about trading psychology. And then the traders who lose money on a consistent basis, they do things differently. They don't value education. So you will not find them wanting to get better as a trader. You will not find them looking for a course, not just any course, but a course from a reputable and a profitable trader. If you were to ask them, how did you get into those last few trades? What happened before you got into those trades? They will not know. And in fact, they don't track anything. And that's why they never make it to the minority side of trading. That means being part of the very small group that are being consistent in their trading results. Prop firm accounts are the same with your personal account, but with a little twist. So let's dive into it. Most people who go out and buy a trading challenge have no business to do so because they don't have a strong reason to why they want to do prop firm challenges. So for you, watching this video is a very strong indication to why you wanted to do prop challenges. But if you don't have this, you will never make it. So before you go out and buy a challenge account, you have to understand why you want to do it. The first reason being you want to trade with more capital, or trading a challenge account will give you some type of mean to move forward with your life. Now, let's say you're already profitable and you have a very good system that is proven to be profitable. You can use prop firm as an accelerator to get you to your goal faster. But you need to ask yourself those questions. Have you been profitable in the past 3 to 6 months on your own personal account? Do you understand the challenge that you're taking? There are 2 phases, 3 phases, 1 phase account. Currently, some prop firm companies offer an instant funded account. Now, when you take those challenges, you have to understand the rules that those account types have. Some of them will take you out completely if you get to a 6% max drawdown. Let's say if you were to go out right now and buy an instant funded account. If you don't have a way of making money on a consistent basis, you will still lose that account. That's why some people, they don't take the 1 phase challenge. They go for the 3 phases and the 2. I get it. Some benefits that you have on the two-phase account, you don't have it in the one phase, because in a shorter amount of time that you can get to funded studies, they tend to make it harder on you. But if you have been a profitable trader and you've been disciplined enough, and without discipline, you cannot possibly make it to being consistent in your trading. You have to understand the prop firm that you are going to buy a challenge from. Has that prop firm been consistent with the payout, and how likely that prop firm is to go under? So basically, you're making an investment in the future. Not only you're parting with your money, but your time, energy, and most importantly, your emotions. Understand all of the parameters when it comes to prop firm challenges. All right, this is the fun part. This is what most of you have been waiting for, which is the strategy development part. Now, what is a strategy? A strategy is simply a recurring event that happens in the market that stick out. Now, let's take a look at the rules of engagement of that strategy. So as you can see here on the right side, you can see a pin bar or a high test candle. And this is what you must have to trade this on a bullish trend. And this is what you must have to trade it on a bearish trend. Now, for the bullish example, the market must be in a bullish trend. Second, the market must be in a pullback phase, meaning when the market is going up, we pay attention to the retracement or the pullback. The only two indicators that you will need for that strategy is the 50 EMA or exponential moving average and the 8. On a bullish trend, the 50 EMA must be below the 8. That means the 8 EMA will be at the top and the 50 will be at the bottom. The market must print a high test candle that opens and closes in the upper third of the candle, meaning when we draw our Fibonacci retracement from bottom wick of that candle to the top wick, the entire body needs to be at the upper third. Entries will go 1 pip above the candle wick, and the stops will go 5 pips below the candle wick. Now, for target placement, there are two ways you can trade this, and this will depend on your preferences. Now, for the first target, you can trade this with a 1-to-1 risk reward ratio. And mind you, that strategy, you can trade it on the 4-hourly time frame and the daily time frame. Either one works. In the secondary target, if you want to trade a 1-to-1 risk reward ratio, you can trade that, and that works fantastic. But if you want to trade with a secondary target, you can take partial target out or partial of your position out at a 1-to-1 risk reward ratio, and the secondary target, you can take the remaining of your position at the retest of previous high. In that example, on a bullish trend. Now, for the bearish trend, it's similar, but the market must be, of course, on a bearish trend, and the market must be in a pullback phase. The market is going down, making lower lows and lower highs, and the lower highs are the area of interest or pullback. The 8 EMA will have to be below the 50. The 50 EMA will be above price, and the 8 EMA will be closest to price. The market must print a high test candle with longer wick to the upside. In the previous example, on the bullish side, we look for a high test candle with a longer wick to the downside. On the bearish example, we need the longer wick to the upside, and that entire body needs to be at the lower third of the candle. Entries will go 1 pip below the candle wick, and stops will go above the candle wick with 5 pips. For targets placement, it's the same as the bullish example. And if you want to trade this with a 1-to-1 risk reward ratio, you can do that. And if you want to trade this with a secondary target, you can trade that with a secondary target that will go at a previous level of support. Now, let's take a live example of that strategy in the pound dollar. We will be taking a look at the 4-hourly time frame first. We take an example of the bullish side, and an example of the bearish side, and then go up to the daily time frame, show you how you can trade this using all scenarios that I just shown you previously. We've had a bearish trend, as you can tell, because we can draw a straight line from the top left corner of our screen to the bottom right. And then that trend was violated at the most recent pullback here at this candle. So basically this candle violated our bearish trend, meaning we are no longer on a bearish trend. The next thing we need to do is to pay attention to what the market will do next. Now we have this as our initial move, a pullback, and then an extension or a run. And a confirmed trend, we must have a 3-point move, an initial move, a pullback, and an extension. We've had that. What we're going to be paying attention to is the market coming down to make a pullback. While we at that, I must show you on TradingView how to add your indicators. So you can see I have a red line here. The red line is my EMA, that's my 50 EMA. And the blue one is the 8 EMA. You will go here on the indicator tab, and then I've already added those as my favorite. So what you can do, you can simply type moving average exponential. Then that's what you do. I just added one here by mistake. You see this one is 9. Now let's say if I wanted to change this to 50 and then color it something else like white, you will see it would add to this one here. So basically that's how you would add your indicator. So I'm just going to delete that. Now I'm left with 1. This one is 9. I'm going to make it 8, and it needs to be blue. So make it blue. That's that. Now, after you added your indicators, you need to go back to the rules of engagement. The market, for the bullish example, the market must be on a bullish trend, which we just had that confirmed. The market must be in a pullback phase. We're having that pullback phase. The next thing, the 50 EMA needs to be below the 8 EMA. We've had moving average crosses there. We had the 8 EMA at the top, the 50 EMA at the bottom. And then we will be waiting for the market to give us a high test candle. Now, we had a candle, that's the signal candle. This candle must at least touches the 8 EMA, or the entire candle can be printed in between those two EMAs. If that candle touches this, it's a valid signal. And also, if it prints inside of here, let's say we had a candle that prints inside here, doesn't touch this and doesn't touch that candle, it's still a valid entry signal. Next one, we need to check to see if the candle open and close in the upper third of that candle. How we find that out? We bring our Fibonacci tool. We draw from the bottom wick to the top wick. We can say this one, the entire body of that candle is above the 382 retracement. This is a very high probability setup. For our entry will go 1 pip above the candle wick. The candle wick was at 123.21. Now our entry will go here, 123.22. Then our stop loss will go 5 pips below that. I'm using the position tool here. Go down here. So 122.93 minus 5 is 122.88. This is for our stop loss. And then for the take profit, you might want to trade this with a 1-to-1. I'm going to check what a 1-to-1 is. This is the 1-to-1. Or you can trade this either with one in and one out, trading this there at the retest. For the second day target, we'll go there, and we can see we have an 8 pips difference, not much. If we did not get filled at the next candle that prints, then we close down our orders. Then we wait for the market to give us another opportunity. Now let's see what happens next. The very next candle that prints put us in the market. Now what we need to do is to simply sit on our hands and wait for one of those two events to happen. Either our stop loss to get triggered or our take profit. The next candle that prints blasted our 1-to-1, even the secondary target that we would have had placed. So this was an example on the 4-hour time frame, on the pound dollar, on the bullish side. Now we will take an example on the bearish side on the 4-hourly time frame. Now on the bearish side, the pound yen has been on a bearish trend. How can we identify that? Easily. Draw a straight line from the top left of our screen to the bottom right. Then we can safely identify that the market has been on a bearish trend. Next thing, the 50 EMA needs to be above the 8 EMA. We had that. The 50 EMA is the red colored indicator, and then the blue one is the 8 EMA. Now, what we need to pay attention to is the market to give us a pullback. So we've had that from here. We got retracement. We got extension. Then we had a violation of that extension, but the market continued on, as you can see here. So this one here was a signal candle, but this one was not. I'm just going to show you that quickly. This one was not what some of you would qualify as a high probability setup, because it opened and closed just slightly below the 50% retracement. To have this strategy work best in our favor, or any other strategies out there, we need to pay attention to the high probability setups. Now after that, the market continued on to give us another run. After that, slight pullback. Now from that run, the market needs to give us a pullback. That's going to be somewhere between there. We had a very nice high test candle there. The entire body is below the 382 retracement. We're going to bring our short position tool. Now we don't know whether or not we'll get filled, but soon as that candle close, this is when we need to place our orders. The candle week was at the price 191.79. We need to place our entry 1 pip below that. That will put us at 199.78. Then stop loss will go 5 pips above that. So 14 plus 5 is 19. And then we place our target at a 1-to-1 risk-reward ratio. So that's the 1-to-1 risk-reward ratio. If you would use a secondary target, what you can do, I'll show you how you would do that. Now you see that candle close there. You would place your secondary target a little bit above that. So you would have to front run your orders there just to make sure that you get filled. You see the close was at 190.92. Some of you would want to be extra careful, and you would put it a few pips above that 191 flat. Or if you don't really care and you don't respect even handle numbers, then you can place your orders maybe 3 pips. It gives you that. But as you can see there, you would only be a few pips away from that even handle number. Me personally, I want my orders to be before that. So 3 pips before that, and that would give us the second the secondary target, and in same stop loss. I'll show you what happens next. Now on this example, since we are taking this on hindsight, we don't know for sure if the market went up to the stop loss price first or if we got filled first. In that example, we will take this as a loss, and then we wait for the market to give us another opportunity should we have one. Then next candle that prints, that's a very high test candle. We will draw our Fibonacci retracement from the top wick to the bottom wick. We see the market, that entire candle is in the bottom third, slightly below the 50 retracement. We do the same thing, short position tool. Our stop goes above that by 5, so 47. This will be 52. And then our target, first target is to be at 1:1 risk reward ratio, and the secondary target, clone that, and the secondary target would be at the retest. Let me put this one there. Let me put this one there for the secondary target. Secondary target would be at the same area, 3 pips above that. Now let's see if we would get filled. Now the next candle that prints, we would get filled. The only thing that we have to do is to wait for the market to do its thing. We see how we started to move further on that candle. We started to move further into our stop loss, and then the next candle that printed blasted through first target and secondary target. Now if we had an example where the market only did this, hit our first target and the secondary target is still there hanging, we would bring our stop loss to break even. Now our entry was at 191.91. Then we would bring it maybe like 5 to 10 pips, depending on the spreads that you get from your broker. This is an example of the strategy on 2 different pairs and 2 different trends. Now we'll go up one time frame, which is the daily time frame. Then I will show you how that strategy works on the daily time frame. Right now we will take a look at the strategy working on the New Zealand yen. We have the bearish approach example. Right now we have been on a bearish trend, so the market has been bearish. What we will look for is the 50 EMA to be at the top and the 8 EMA to be at the bottom. The 8 EMA will be the closest to price and the 50 EMA to be the second closest to price. What we will be waiting for is for price to push and have a retest into those indicators. Now we see here we've had our run, then we have the pullback, and in the pullback we see that entire candle body is in the lower third. And how we can identify that, very simple. We bring our fib retracement tool, then we go from the top wick of the candle to the bottom wick, and we put a line at the 32 retracement. We can see the entire body is below that. So simply put, next thing, the 50 EMA must be above the 8 EMA. That happens very clearly. We see it there. And then the next thing we have to do is to place our orders. Now, the type of orders we will be placing will always be a stop order for our entries. And that example will be a sell stop order. This stop order is simply telling your broker to put you in the market when price reaches that level. A stop order is a type of order that you place below price, and then you tell your broker to either get you in the market or get you out, because a stop order is used to both enter and exit the market as a stop loss. So we will be using our short position tool. We do the same thing that we did on the 4-hourly time frame. Now the price was 88.80. Then our entry will be 88.79. We have that, and then our stop loss will go 5 pips above that price at the wick is 89.70. And then we will place our stop 5 pips plus 5 is 79, 89, 79, 75. The first target will be a 1-to-1. So this is our 1-to-1. So I say first target is because if you want to trade this with a 1-to-1, if you want to trade this with a 1-to-1 risk reward ratio only, you can do that. And or if you want to trade it with a 1 in 1 out, but you only look for a retest of the previous structure low or previous structure high, you can also do that. And sometimes you get a much better risk reward ratio. But if you trade it only 1 in and 1 out, what you will find out is your strike rate decreases. For that reason, and for that reason only, I would encourage you to go ahead and backtest it with the 1-to-1 risk reward ratio and see how many times that the market retests the previous level, because you will always have a much higher strike rate trading it with a 1-to-1 risk reward ratio. Now we will place our secondary target at previous level of structure, but a little bit above that. So we will front run our orders. So the close was at 86.96, right above that 87 flat. And we don't want to be below that price. We want to be above it by a few pips. So by 3 pips, I believe that's good enough. Next thing we have to wait for is for the market to get us in. Now the next candle that printed, we were in the trade. Now we have a open position. The next thing we have to wait for is either get our stop loss hit or our first target hit. Now let's see what the market does. You see the market now, watch this, the market just got us with our 1-to-1 risk reward ratio. Now our first target would be hit, then this is out of the market. The next thing to do is to adjust our stop loss. So stop loss would go from there. I will just put a line there. So our entry was at 88.80. Then we can bring our stop loss 10 pips. Sometimes you can get away with 10 or 15, depending again on the spread and the pair. You can place it there like 70. So this would represent our new stop loss. We simply wait for what the market will do. As you can see there, I'll show you again a reason why you need to place your targets away from those even handle numbers. So as you can see there, the price reaches 8705 and we only front run our orders by 3 pips. Now the market would go without us, and then you see what happened there. So this is when you go and backtest that strategy. You will make those adjustments, and you can see on the daily time frame, you can have more leeway in placing your secondary targets. You can say, I'm going to be front running my orders by 10 pips. If you were to do that by 10 pips, so there goes your close of that candle. It was at 86.96, and then if you were to do that at 87.06, watch this, then you would get your secondary target hit. You can only make those adjustments by backtesting that strategy. And if you think you can watch this or watch me teaching you this super profitable strategy and treat it as an off-the-shelf strategy to go and trade it on your accounts, forget it. It will not work for you because you have to know your numbers. Now let's take an example on the bullish side. On the Euro New Zealand, draw a straight line from the bottom left of our screen to the top right. Then that would give us our bullish trend. Now we see the market
has been putting a series of higher highs and higher lows. And this entire thing was a complex pullback that did violate the newly confirmed trend, but the market continued on. So what we will wait for the market to give us is a pullback, and from that pullback we will be looking to trade that market up to the next level. Now the market is giving us a pullback. We started to have the pullback. Then we need to wait for the market to print a very high test candle. Now we just had that, and this one is an example of what I was telling you earlier about a candle that can print in between those two indicators. That will be a valid one as long as the entire body is at the upper third. So you can see this one here is at the upper third, but slightly below that 3D2 retracement. We have the 50 EMA at the bottom and then the 8 EMA at the top. Bring our long position tool. Entry will go 1 pip above that, so 183.83. So 183.84 is where we place our entries. Our entries go there. Then our stop will go 5 pips below. So 5 pips below would put us at 183.01. Now check this out. 183.01 is only 1 pip away from 183 flat. I don't want to be anywhere near that or too close to it. I'm going to be placing my stop loss 5 pips below that even handle number. So 5 pips below will put us at 182.95. And then we look for a 1-to-1 risk reward ratio. 1-to-1 risk reward ratio. There we have it. And then we're going to clone that. Check for our secondary target at the retest of the highs, but we'll place our entry, we will place our target, let's say 10 pips away from the close. So the close was at 185.34, then 185.24. Now we simply wait for the market to do its thing. Next candle that printed, this candle wick, I'll show you one thing here, tested the 183 even. So that's why those prices or those areas are very crucial when it comes to entry placement, target placement, as well as stop loss placement. Now in that particular scenario, we were saved because we took into consideration the even handle number. Let's see what the market did next. We started to trade sideways, so 3 days sideways, and then another sideways market there. In that candle, on that day, the market would get us out with our first target. That is if we trade the 1-to-1 risk reward ratio with a secondary target. We would remove that, and then we would roll our stop. I'm going to be using that for our stop. Roll our stop to break even. The next candle that prints would get us out with a break even position. So the market traded sideways for a couple of weeks, and then we did put some lower lows there, and then the market continued on with its bullish move. So in that case, the only targets that got hit was the 1-to-1 risk reward ratio. I hope this was an eye-opening for most of you. This strategy is very profitable, and this is what I trade mainly on my swing trading account. And currently I'm doing a challenge. Is an instant funded challenge that I'm currently trading with that strategy. And I hope this will give you the utmost confidence to go out and simply trade that confidently. For you to get that confidence, you need to do back testing, and you need to do sometimes forward testing. If you don't feel like you're ready and you would still want to earn your prop firm money that you've been wasting, I have an offer for you. This is where you can get inside of a closed group where the seats are very limited, because I want to work with serious traders who want to get on the minority side. The minority side, the only traders who are consistently making money. And if you would like to be part of that, I have a link down in the description below where you can get signed up, where you can reserve your spot. I say reserve your spot because I'm only going to be taking 100 of you. Those 100 people who will be lucky to be part of that circle will be trading alongside of me, and I will give you everything that you need for you to go out and confidently buy any prop firm of any size, of any type. And you will not only pass your prop firm challenges if you want to do prop firm challenges, or you can do an instant funded account with the prop firm that currently offers an instant funded account. And not only you will have a return on your investment from those prop firms, you will be able to keep your accounts for as long as those prop firms exist. And why am I making such a bold claim? Is because that what I'm going to give you is working. It's working for me. And if you're willing to learn, if you're willing to listen, and if you have the passion for trading, you will be making it too. I know you can make it because I'm currently making it. And if I can make it, you can make it too. And this is the bet that you have to make on yourself and yourself alone, because nobody out there cares about you but yourself. If you don't want to be part of that close group and you feel like you have the confidence to go out and trade that strategy, I'm rooting for you, because this, you can trade this, you can take this strategy, back test it, and go out and trade it. With that said, for those of you who will get signed up, I will see you inside of that program. And for those of you who will be trading that strategy on your own, best of luck. Please let me know down in the description below how you are doing and how I can help out. And if there is something else that you are hoping to learn in that entire program I did not cover, comment it down in the description below.